Hi class, today's lesson will be chapter 3, problem 3B. You should be able to see my Excel spreadsheet now. I've copied from Cengage into Excel, and I wanted to show you again how to do adjusting entries. We're going to put these in T accounts first because we analyze our adjusting entries through T accounts first. Then I'm going to copy them into the journal. So we're going to be Crazy Mountain Outfitters, and we're an outfitter store for fishing treks, and we prepared the following unadjusted trial balance at the end of its first year of operations. The end of the year is going to be April the 19th. This is the unadjusted trial balance that would come from your ledger account balances. What they want you to do is they want you to prepare adjusting entries using the following additional data. So we're going to start with supplies. Supplies is a prepaid expense, which is also a deferred expense. Deferred expenses are going to show our expenses in the time period that they belong in. We're going to put the expense off until the period of time that we've incurred it. So supplies, we're going to start with our T account first. I'm going to go to my unadjusted trial balance and pick up the amount of supplies that we had in that account. The amount is $7,200. I'm going to record that as my unadjusted trial balance amount. These T accounts represent your ledger accounts. The unadjusted trial balance amount is showing that you had $7,200 worth of supplies at some point in time during this year. Our additional data tells us that the supplies that we have left over now are $1,380. So the supplies that we have on hand are the supplies that should remain in the supplies account. So the balance at the end of this year was $1,380. What we have to show is that the account has gone down by $5,820. How do we find that adjusting entry amount? You take the unadjusted trial balance and subtract the amount that you have on hand, and that will tell you what you have used up. If you've used up the supplies, we need to decrease the supplies account by putting it on the credit side. This is what we call an adjusting entry because we have to update the unadjusted trial balance amount to the correct balance so that when we report our financial information on financial statements, our financial statements will be correct. So we're reducing the supplies account, which is an asset, by crediting it. Every adjusting entry has to have at least one debit and one credit. My debit is going to be to supplies expense. I have created this account because I have used up this amount of my supplies. Now I have a supplies expense account that I have to show in my ledger. And so my supplies expense is going to be debited in the journal. My supplies account will be credited in the journal. Remember, when you do your T accounts, they're just tools to help you to get your journal entries straight. Always put your debit first in the journal, which would be just supplies expense in this case, and our credit would be to the supplies account. You're going to indent, put supplies, put it in the credit column, and then you remember from chapter 2, once we have a journal entry in, we would need to post that back to the ledger account. I didn't make ledger accounts for you because I figured you know how to post. You should have learned how to do that in chapter 2. But once you get the information in the journal, then we copy from the journal back to the ledger, which will update our accounts. And eventually we'll prepare what we call an adjusted trial balance. And I'll show you how to do that in just a moment. Our second adjusting entry that they've got for us on line 28 is fees earned but unbilled. The word there, unbilled, means you need to sit down and send an invoice to your customers. You've got some fees earned, but if you hadn't sent them a bill, you haven't recorded that information in the journal. And so you're going to want to record the information that you have earned in your journal. It hasn't been recorded yet, so we need to fix that. We need to update our fees earned as well as our accounts receivable for the unbilled amount, because we are expecting to receive cash in the future from this transaction. Fees earned but unbilled is an example of accrued revenue. Accrued revenue is revenue earned but not received yet. If it's not received yet, we have to put it in the accounts receivable account and try to collect from those customer accounts. So in the unadjusted trial balance that was given to us, the accounts receivable ledger account had an unadjusted amount of $72,600. I just put that in as the unadjusted balance. You're going to need to update this accounts receivable because we've got some fees earned, but we're unbilled. So we need to send them a bill. And when we send them a bill, we're going to put that as an increase to our accounts receivable. Accounts receivable is an asset account, and assets increase on the debit side. So my adjustment portion of this is for $3,900 that will increase my accounts receivable. Because this is an example of an accrual, both accounts are going to increase. My fees earned is also going to increase by $3,900. So fees earned also had a balance in it from your unadjusted trial balance, or your ledger account had this balance in it. Now we're going to need to add $3,900 because of this transaction here where we had where we had earned fees but not billed, which means it's accrued revenue. If it's an accrual, both accounts are increasing. I'm going to increase my asset account, and I'm going to increase my fees earned account, which is a revenue account. To increase revenue, we would credit. To increase accounts receivable, we debit. In our journal, always put your debits first. My debit is to accounts receivable for $3,900. I indent and write in my credits. My credit is $3,900 to fees earned, which is a revenue account. Accruals increase both accounts, whereas your deferral, like we did up here, one account went down, that was your supplies account. Remember to decrease supplies, which is an asset, you credit, and the expense account went up. So there's a pattern to these, and I think once you see that, you won't have any trouble with creating adjusting entries. Make sure you learn the types of adjusting entries that we covered in the first video that I recorded for you. You need to know that fees earned but unbilled is accrued revenue. And if it's accrued, both accounts are going up. On my next line, we've got depreciation of equipment that was estimated to be $3,000 for the year. Depreciation is not an accrual and it's not a deferral. I think in your textbook they kind of put it as a deferral, but I don't like that. I'd rather you think of depreciation as its own category. Depreciation is the only category where the expense will increase and it has with it a contra asset account that we call accumulated depreciation. So draw you a T account, label one of these depreciation expense, and label the other one accumulated depreciation. It's important that you know that accumulated depreciation is a contra asset account. Because it's a contra asset account, it will have a normal credit balance, or it will increase on the credit side. Now, my accumulated depreciation wasn't even listed in my unadjusted trial balance up here. So most likely this is equipment that we have bought sometime during this year, and now we're going to have this accumulated depreciation account that we have to create to go with the depreciation that is being allocated over the life of the equipment. The cost of the equipment is being allocated when we depreciate. The amount is $3,000. Now with depreciation entries, this is the adjusting entry that will always be the same. It will always be a debit to depreciation expense, and it'll always be a credit to accumulated depreciation. And the amount will be the amount of the depreciation expense for that period of time. So in our journal, we're going to debit depreciation expense and credit accumulated depreciation for $3,000. The next account that we're going to be adjusting is unpaid wages that were accrued. Now there's a big hint there when it says accrued, and you know it's some kind of accrual. If it has to do with wages, we're going to pay them at some point in time. We just haven't paid our employees yet. So it matches the definition of accrued expense. Accrued expenses are expenses that we've incurred during this period of time. We just haven't paid those expenses yet. So maybe payday goes into a new accounting period, next period. What we're showing here is just what we have incurred as far as wages expense were concerned. So my accounts that I'm going to use for recording an accrued expense would be wages expense and wages payable. An accrued expense is an expense that's been incurred that you need to record. So wages expense just happen to have a previous balance in there from wages that you did pay in this accounting period. This unadjusted trial balance amount came from the unadjusted trial balance from up above. That was a given amount. We needed to add to our wages expense for this period of time the adjusting entry amount of $24.75. The additional information told us that the wages expense that had accrued is $24.75. So that adds to our expenses. Our expenses are always going up in this chapter, so we're going to debit our wages expense, and we're going to credit a liability account that we make up called wages payable. All payables are liabilities, and this is just saying, hey, we owe wages payable. We're going to pay that in the new accounting period. But for right now, we've got to record how much is expense during this accounting period so we can match it properly with revenues for this accounting period. You want to make sure that you have all your revenues accumulated in this accounting period and all of your expenses accumulated in this accounting period. Because remember, when we prepare an income statement, we're going to match our revenues with our expenses. Remember when you took the total expenses from the total revenue to find net income? That's why we need to record all the expenses in the period of time that they belong in. And that is whenever the expense is incurred. So wages expense is debited, wages payable, which is a liability, is credited. Both of these are going up because they are examples of accruals. My last adjusting entry for this problem has to do with unearned fees. Anytime you see unearned fees, you should know now that unearned fees is a type of deferred revenue. Unearned fees means that we have received money in advance before we have earned these fees. At the end of the accounting period, we're going to look at the unearned fees account to see if any of these fees have been earned during this time period. If they are, we're going to reduce the liability account, unearned fees, by the amount of fees that are earned, and we're going to record our fees earned account. So look at the balance in the unearned fees account. It is shown on the unadjusted trial balance. The unearned fees is $19,200. Create a T account, and we're going to put the balance on the credit side because unearned fees is a liability account. The unadjusted amount was $19,200. That's no longer correct, so we need to update this unearned fees account for the amount of the fees that are earned. How do I find out what is earned? Read carefully. It says the balance of the unearned fees represents an April 1st receipt, but now it's at the end of the accounting period, and only 14,140 of the services was provided between April 1st and April 30th. So this amount right here is earned. If it's earned, it can't be unearned. So we got to reduce the unearned account by the amount that is earned. To reduce unearned fees, we would debit it because you're decreasing a liability. So my adjustment will be a debit to unearned fees, and the credit to that adjustment will go to fees earned. Fees earned is increasing. So in our journal, we debit unearned fees for $14,140, and we credit fees earned for $14,140. And that's all of the adjusting entries that they wanted you to prepare for this period of time. Now, this problem has another part to it. And that other part is a what-if analysis. Part 2, they want you to determine the revenues and expenses and the net income of Crazy Mountain Outfitters before you did the adjusting entries. Now, class, I don't know why in the world they ask you to do this, because if you prepare an income statement before you do adjusting entries, your income statement will be wrong. It just is wrong. So technically, you should always prepare an income statement after you have prepared adjusting entries. Now, something that I did that they didn't ask you to do was to prepare an adjusted trial balance, because in this chapter, you're going to need to know how to prepare an adjusted trial balance. My adjusted trial balance is prepared from my ledger accounts that I have posted my adjusting journal entries to these ledger accounts. Actually, all of the ledger accounts are put on the adjusted trial balance, not just the accounts that have been adjusted, but all accounts should show up here on the adjusted trial balance. You will use this adjusted trial balance to help you to prepare your financial statements correctly. The adjusted trial balance is the trial balance after you have posted the adjusting entries to the ledger. So you'll remember when we journalize adjusting entries, we put them in the journal. We copy from the journal to the ledger by a process we call posting. We learned how to do that in chapter 2. It's no different in chapter 3. Posting is always copying from the journal to the ledger. Once we post the adjusting entries, the ledger accounts will reflect new balances that will go on the adjusted trial balance. So I prepared an adjusted trial balance for you because you need to know how to do this, especially in the next chapter. You're going to need to know how to do this before we can talk about what goes on in the next chapter. We're just adding steps as we go through these chapters. So even though they didn't ask you to prepare an adjusted trial balance, I did one for you. And it's coming from all the accounts that are in the ledger. So we'll start with the cash account. And because we didn't adjust cash at all in any of our adjusting entries, we're just going to pick up the balance of the cash account and put it on the adjusted trial balance. My accounts receivable would come next. That's the next account. Don't use this balance because this is the unadjusted balance. We want to make sure that we have adjusted accounts receivable for any accruals. So I've got to go to my T account, pick up the ending balance of $76,500, and I'm going to put that on the debit side. And then we'll go to equipment. The unadjusted trial balance amount was $112,000. We did not purchase any more equipment this year, so you just use that $112,000 amount. Notice in your unadjusted trial balance, the next account is accounts payable, but that wouldn't be correct on your adjusted trial balance because we created an account when we adjusted depreciation called accumulated depreciation. It is a contra asset account, so accumulated depreciation will be found in the ledger right underneath the equipment account itself, because accumulated depreciation offsets the equipment account. You must have a ledger account set up called accumulated depreciation, and now it has a balance in there of $3,000 because of our adjusting entry for depreciation. So supplies comes next. Don't put the unadjusted trial balance in. Put the adjusted trial balance in. Remember, we made an adjusting entry that will reduce supplies down to the correct balance. The correct balance now is $1,380. And I think I've gone through enough of these to where you can see where the amounts are coming from. So I want to move on. And so make sure that your adjusted trial balance balances up if you were required to do an adjusted trial balance. You would want to make sure it balanced up. And you will use the information from the adjusted trial balance to prepare your financial statements. Now again, in part 2, they ask you to determine the net income, which is really preparing a financial statement. But you should never, ever, ever, ever prepare an income statement before your adjustments, because it's going to be wrong. Why they ask you to do this, I don't know. But this is how you would prepare it. Remember, you got to record all your revenues and all your expenses. The difference between your total expenses and your total revenue is the net income. So the net income before the adjusting entry is $44,000, which is not correct. Then in part 3, they say determine the revenues and expenses and net income after the adjusting entries have been prepared. This is the correct income statement. Notice we've got fees earned on there, and we got a few more expenses, because when we created our adjusting entries, we added to our ledger accounts. The total of my expenses after the adjustments are $273,095. I get a list of my expenses from my adjusted trial balance. Do you see, here's all your expenses. I just copied that and pasted it down into this statement here. So all of these expenses added together, the total expenses are $273,095. The total expenses would be subtracted from your total revenue. Notice your net income is $50,745. This is the correct amount of net income. So the net income after the adjusting entries for part 3 is $50,745. The total revenue is this. The total expenses are this. The expenses subtracted from the revenue leaves you with net income of $50,745. From chapter 1, you learned how to prepare an income statement. Remember, the amount of the net income will add to your owner's equity. So what I did is I prepared a statement of owner's equity. Again, what they're asking you for in the next part is what happened to the owner's equity. And in order for you to be able to see how I did this without just guessing how you'd come up with it, I put it down step by step. Notice I've created a statement of owner's equity after your adjustments. This is the correct owner's equity. And the owner's equity statement would start with your beginning amount of owner's equity. Notice the year end was April 30th, so the beginning of the year was March 31st. March 31st, the beginning capital was $137,800. Where would I find that? I would find that in my adjusted trial balance. Here's my adjusted trial balance. This is the amount right here. That is my beginning owner's equity that I'm starting with for this company. Because the owner did not make any additional investments, they didn't tell us anything about the owner going out and giving the company some more cash. I'll just put down a 0 here. If you had owner's investments, it would go right here, but there were none in this case. What you have to know is that net income will add to your owner's equity. Remember, the things that affected owner's equity are revenues and expenses. We've combined our revenues and expenses to get net income, and net income will add to our beginning owner's equity. So net income is going to be added to this beginning owner's equity to determine the ending owner's equity. You also have to remember that owner's equity would be decreased by the amount of the owner's withdrawals. The owner's withdrawals were listed at $10,000. That's the drawing account, and that's the amount of the withdrawals. So the owner's withdrawals of $10,000 are going to subtract from the net income to get the increase in owner's equity. In other words, if I had additional investments, these would have been added, but since it was 0, there were no additional investments. So all I had to do is take my net income, which adds to owner's equity, and minus out what the owner took out for personal expenses, which was $10,000. There is an increase in owner's equity during this time period, which would be added to your beginning capital balance to get your ending capital at April 30th. This is the correct amount of capital at April 30th. Now, what I did to show you what they wanted you to determine, which was whether or not owner's equity increased or decreased, and if it did, how much was it and why was it? This is what would have happened if we had created the statement of owner's equity before adjustments. You should never do this, class, but this was what would have happened. Our beginning capital balance would have been the same. There were no additional investments, but the net income before adjustments were made, remember we figured it out up here, before adjustments are made, the net income was $44,000. So I just took that $44,000 and put it right here. The withdrawals were the same, so the increase in owner's equity would be $34,000 before adjustments, which is wrong. The increase in owner's equity would be added to your capital balance to get your ending capital, which is wrong because this is before adjustments. So if this was what it was after the adjustments, and this is what it was before the adjustments, there's a difference here of $6,745, and that is, this should have been the ending owner's equity, which means there was an increase in owner's equity because of adjustments for the difference between these two amounts, which was $6,745. And that should give you the whole picture as to what they wanted you to do with problem 3-3B. So I'm going to stop sharing this with you, and I'll see you next time. Bye-bye.